was so beautiful, nothing could tear us apart. A picture of forever and promises made from the heart. But memories fade as time slips away. Where does that leave me and you? With no more regrets, I'll cherish these moments I'll never forget.
I'll take you there one day.
Promise?
Promise. So tell me how to love you with no more regrets. Now cherish these moments, the memories you'll never forget. The memories you'll never.
I may sometimes forget you here, but never here.
The memories you'll never forget.
Moves to the beat of progress. And no one knows its pulse like BDO Bank. With leading scale and reach, the the expertise and local knowledge to connect you to Philippine business. BDO Unibank. We find ways.
From the beginning, mankind survived by following rules. Rules that are measured by faith and made with wisdom. It is written in Genesis chapter 6, verses 15 to 16. This is how you are to build it. The ark is to be 300 cubits long, 50 cubits wide, and 30 cubits high. Make a roof for it, leaving below the roof and opening 1 cubit high all around. Put a door on the side of the ark and make lower, middle, and upper decks. Capitalizing on the historical learnings of Noah on how the ark was built with precise instructions, Noah Business Applications has been meticulously designed to deliver substantial results that complied with the financial and operational requirements of various companies across different industries. The success of Noah Business Applications is rooted in its strong, proven, and sustainable implementation methodologies from appreciation sessions to knowledge sharing. Noah conducted 4 levels of tests before he led all the creatures out of the ark after the great flood. All these tests were written in Genesis chapter 8 verses 6 to 12. These tests are paralleled with Noah Business Applications 4 levels of test, namely developers testing, system integration testing, quality control testing, and user acceptance testing. For 20 years, Noah Business Applications advances the roles of enterprise resources planning from forecasting, planning and budgeting, financials and procurement management, financial consolidation, loan management, real estate management, project management, healthcare and wellness management, human resources management, banking, warehouse management, production, distribution, customer relation management, mobility or IoT, analytics reporting and dashboard, and data management. Noah Business Applications, advancing the role of ERP.
First Park Homes was formed from the partnership between Century Properties Group and Mitsubishi Corporation, having that goal to raise the standards of community housing in the Philippines without costing too much. Unlike other housing communities, First Park Homes is actually what they call the 4 C's. It's the brand pillars which they follow. It stands for complete, conceptive, connected, and convenient. Oh, complete because their homes are fully finished, which means the walls are painted, you got your complete flooring. This place is secure and you got provisions to expand. Basically, all you need are your furniture and you're ready to move in. How easy is that? Conceptive because First offers amenities which go beyond the basic. Get this, for every subdivision, there is a specific theme for the amenities which can be enjoyed by both young and young at heart. They have amenities that promote the arts, encourage good health, build social development, and strengthen the community. Like for example, in Bulacan, they have these life-sized board games. In Lipa, they have traditional Pinoy games, and they even have an outdoor cinema. I think it's really amazing that they're introducing unique amenities for families to enjoy. First aims to keep everyone connected to life essentials. Imagine they even have a shuttle to bring you to nearby transport hubs. Now that is hassle-free. Lastly, convenient. Owning your first home is now easy through First's simplified buying process. Owning a First Park home is more than just an investment. It's your first home that lasts.
SM Investments is one of the largest Philippine conglomerates. We've been around for over 60 years. We have 3 core businesses, mainly retailing, banking, and properties. Over the past 60 plus years, sustainability is something which SM has had as a culture. It's something which we as a group has been practicing from the very beginning. We take into account the entire impact on the environment, including, let's say, providing sustainable energy, renewable solar powers, water treatment facilities, and waste recycling. We also provide, like for example, for our malls, we make the malls more like a community center, which also then becomes like an area for relief effort if ever there's any sort of calamity that occurs. We also provide support in terms of education and training and healthcare, because at the end of the day, it's the sustainability of the community that continues to provide the growth for our businesses. Biodiversity is very important in everything that we do as a country and as individuals. For example, in our Hamilo Coast development, we work very closely with the WWF in terms of reforestation and also culturing more mangroves in the area.
There is this climate change that's looming over our Mother Earth. If we can contribute no matter how little, and if I can get everybody to be aware of it, I think we will make an impact. It's never too late.
Sustainability is very important because for a business to be able to continue to grow and last for many, many years, it's very important that the business support the community in a sustainable way. Because in the end, it's also the community and the environment that sustains the high growth of our businesses.
The all-new Lulu Money app brings you more features and convenience than ever before. With more services under one roof than any other app of its kind. Send money to bank accounts instantly. Collect cash at popular agent locations. Send money to any mobile wallets. Pay your bills. Perform mobile top-ups. Load Lulu Money wallet. Check forex rates and much more. Lulu Money. Anytime, anywhere.
What's more important for you? Completing your to-do list or your shopping list?
Finally!
Is it making sure everything goes according to plan?
That's the plan.
Boom! Sold! Or is the plan not to have one?
Bahala na.
Whatever your choice is, we'll help you achieve it however you want to. Because at Maybank, we know exactly what you need. And that is to help bring you closer to what truly matters for you.
Senyales ang silanganan, alam ng puso, sa dibdib mo'y buhay. Lupang inirang, duyan ka ng magiting, sa manlulupig, di ka pasisiil. Sa dagat at bundok, sa simoy at sa langit mong buhaw, may dalagang tula at awit sa paglayang minamahal. Ang isap ng watawat mo'y tagumpay na nagniningning, ang bituin at araw niya kailan pa may di magdidinig. Iba ng araw ng walhati ng sunda, uwi langit sa piling mo. Ang ligaya na pag may pangalit, na pumatay ng dahil sa'yo.
Good morning. I am Dante Clincan, Chairman and CEO of the Manila Times. Welcome to today's Business Forum looking at the economic outlook for 2022 and beyond. First of all, I'd like to greet our speakers this morning, Governor Benjamin Jokno, the Bangko Sentral, Dr. Kelly Bird of the Asian Development Bank, Dr. Ndiame Diop of the World Bank, Mr. Aftab Ahmed of City Philippines, and Mr. Milo Sandig of Digital Innov. We are looking forward to hear their presentations this morning to see whether or not 2022 will finally be the year the Philippines will get back on track. I think there were a lot of hope last year that that might happen then, but of course, the latter part of the year we saw Omicron emerge. Of course, this year there's a lot of hope banking among all of us. There is, of course, the added GDP spending that will be resulting from the election spending. And of course, as we see from the news yesterday, the Omicron cases are below 1,000 for the first time. But of course, there are some dark clouds ahead. There's, of course, a delay in the signing or the ratification of the RCEP. There's also the conflict in Ukraine, which, of course, we are feeling today in the pump prices, and perhaps soon we may be feeling in other things such as electricity prices. So I'm sure we are all eager to hear what our experts have to say this morning. But before we start, allow me to thank our partners who made this event possible this morning. They are our co-presenters, Citibank, Digital Innov, and Infiniban. Thank you also to our gold sponsors, BDO, Mega World, NOAA Business Applications, First Park Homes. Thank you to our silver sponsors, San Miguel Corporation and SM Investments Corporation, and our brown sponsors, First Gen, Hilton Manila, Pelu Money, Maybank, Smart Trade, Udena, and Veterans Bank. Today's event would not be possible also without our organizational partners. So thank you to the Management Association of the Philippines, or MAP, the Financial Executives Institute of the Philippines, or FINEX, the Davao Chamber of Commerce, the Cebu Chamber of Commerce, the French Chamber of Commerce and Industry in the Philippines, the British Chamber of Commerce of the Philippines, and the Italian Chamber of Commerce in the Philippines. And finally, thank you to our media partner, the Manila Times TV. Thank you also to all those watching this forum this morning. And for all of those who are watching this at a later event, the Manila Times print and digital editions will carry stories about the presentations this morning. So with that out of the way, allow me now to introduce our keynote speaker. Dr. Benjamin Jokno is the current governor of the Bangko Sentral ng Pilipinas, or BSP. Prior to his appointment, he served as budget secretary from 2016 to 2019. On his third tour of duty at the Department of Budget and Management, he pursued an expansionary fiscal policy to finance investments in human capital development and public infrastructure. Under his leadership, the BSP the BSP was among the first central banks in the world to respond to the COVID-19 crisis. The prompt and extraordinary monetary measures provided a significant cushion to the current state of the Philippine economy. Against this backdrop, international publication The Banker named him Global Central Bank Governor of the Year for 2022, a first for the Philippines. As BSP governor, it has not only pursued the BSP mandates of price stability, financial stability, and an efficient payments and settlement system, but also endeavors to bring central banking closer to the people. He's a champion of digital payments and financial inclusion. In his pursuit, he aims to shift at least 50% of retail payment transactions to digital form and achieve 70% transaction account ownership among adult Filipinos. He is a strong advocate of the Philippine ID system. Governor Jokno, good morning, sir. May I first ask you to unmute your mic? The screen is yours, Governor.
Good morning, King. Thank you. Asian Development Bank Country Director Kelly Bird, World Bank Country Director for Brunei, Malaysia, Philippines, and Thailand, GMA Diop, Manila Times Chairman and CEO Dante Klink Ang II. Ladies and gentlemen, good morning. And thank you for inviting me to discuss latest economic developments and outlook in this forum, aptly titled Looking Beyond the Pandemic Endgame. Today, I'll cover the following. First, an update on the Philippines' recent economic performance. Second, the BSP's support to the economy to ensure strong and sustainable economic recovery. And third, economic outlook. To begin, after 5 consecutive quarters of decline, the economy rebounded strongly in the second quarter of last year with a growth of 12%. Since then, the country has managed to sustain this positive growth amid a calibrated approach to virus containment. In Q4 2021, the economy grew 7.7%, resulting in a 5.6% full-year growth. The full-year GDP growth exceeded the government's target range of 5 to 5.5% for the year and beat market expectations. The country's quarter-on-quarter growth improved in the last 2 consecutive quarters, bringing the economy closer to the pre-pandemic level posted in Q4 2019. The job situation has improved. The unemployment rate fell to 6.6% in December 2021, down from the peak of 17.6% in April 2020. Moreover, employment level last December reached 46.3 million, representing a 3.8 million net employment gain from the pre-pandemic level in January 2020. Yet employment in some quarters that require close contact has yet to recover, particularly accommodation and food services and transportation. Manufacturing activities moderated, with the Purchasing Managers Index, or PMI, settling at 50% in January 2022. This came about following reimposition of stricter quarantine protocols amid the spread of the Omicron variant. Nevertheless, the latest PMI still showed improvement from the manufacturing declines recorded earlier in the pandemic. Also, businesses reported growing optimism for the year ahead, owing to improving overall COVID-19 situation and rising vaccination rate. New confirmed COVID-19 cases in the country are falling. With low hospitalization rate and rising vaccination rate, the COVID situation is stabilizing. Google mobility data as of February 15, 2022, show that mobility trends were higher relative to the baseline for retail and recreation, grocery and pharmacy, and parks following relaxation of alert levels. Headline inflation slowed to 3% year-on-year in January 2022 from 3.7% a year ago and 3.2% in December 2021. The January 2022 inflation was at the midpoint of the government's target range of 2 to 4% for the year. The slowdown in inflation in January was mostly driven by slower price increases of selected non-food items along with alcoholic beverages and tobacco. Inflation for housing, water, electricity, gas, and other fuels slowed down in January, while prices of liquefied petroleum gas also fell. Food and non-alcoholic beverages inflation held steady compared with the previous month. However, transport inflation continued to increase given rising global crude oil prices. Private sector economists expect inflation to average at 3.5% this year and 3.1% in 2023, within the official target range of 2 to 4%. The BSP projects February 2022 inflation to settle within the range of 2.8 to 3.6%. Inflation projections of multilateral agencies and market analysts for 2022 and 2023 are also within the government's target range. The country's external sector remains manageable. The sustained rebound in key economies has spurred external demand. Exports of goods increased by 16% in the first 3 quarters of 2021. Similarly, imports of goods grew by 30.2% on stronger domestic demand for raw materials and capital goods. Net foreign direct investments increased due to positive foreign investor sentiment on the country's macroeconomic fundamentals and strong growth prospects. Foreign direct investments rose 52.2% to $9.2 billion from January to November 2021. This development bodes well for job creation. The gross international reserves, which stood at $107.7 billion as of end January 2022, continue to provide more than adequate external liquidity buffer. The GIR level is equivalent to almost 10.2 months worth of imports of goods and payments of services and primary income. This far exceeds the 3-month conventional reserve level considered as adequate. It is also about 8.4 times the country's short-term external debt based on original maturity and 5.7 times based on residual maturity. The GIR is supported by improving inflows of cash remittances from overseas workers, receipts from business process outsourcing, and FDI inflows. Now, on the banking system, liquidity in the financial system remains adequate. Preliminary data show that domestic liquidity, or M3, grew 9.8% year-on-year in January 2022, following a 7.3% expansion in the previous month. Bank lending has improved, increasing at a faster rate of 8.5% year-on-year in January, from 4.8% in December. As of end December 2021, the gross non-performing loan ratio of the Philippine banking system stood at 4%. While this is higher than the 3.6% recorded the previous year, it is still lower relative to the previous month's 4.4% and far from the double-digit level seen in the Asian financial crisis. Banks have ample loan loss provisioning, with the NPL coverage ratio at 87.4%. The Philippine banking system remains well capitalized. As of the 3rd quarter of 2021, capital adequacy ratio, or CAR, was at 17.1%, well above the 10% minimum threshold set by the Bangko Sentral ng Pilipinas and 8% by the Bank for International Settlements. The BSP will continue to closely monitor the impact of emerging COVID-19 variants on the banking system. Supervisory and surveillance tools have been strengthened to ensure that appropriate focus and attention are placed on this area. 2 years since the onset of the COVID-19 pandemic, the economy is on its way to recovery, thanks in part to swift and decisive actions by the government. The government's mass vaccination program is picking up pace and scope and is expected to accelerate further. In 2020, the government passed Bayanihan 1 and 2 laws and allocated a portion of the 2021 national budget to fund COVID-19 response. The recently signed 2022 General Appropriations Act contains fiscal stimulus crafted with continued COVID response and recovery in mind. Together with the extended 2021 GAA, the budget will support continued implementation of COVID-19 recovery measures and help the economy bounce back. Moreover, the government passed into law reforms that could foster strong and faster economic rebound. This includes passage of the Financial Institutions Strategic Transfer, or FIST Act, and the Corporate Recovery and Tax Incentives for Enterprises, or CREATE Act. Meanwhile, the proposed Government Financial Institutions Unified Initiatives to Distress Enterprises for Economic Recovery, or GUIDE Bill, aims to strengthen the capacity of government financial institutions to assist micro, small, and medium enterprises to cope with the effects of COVID-19. Complementing the government's responses, the BSP has implemented temporary and time-bound policy measures. First were measures to boost market confidence, such as cuts in the policy rate and the reserve requirement. The lower policy rate was meant to influence banks to cut their own lending rates, thereby promoting credit-taking activities. Meanwhile, lower reserve requirements increased the volume of loanable funds. Second were extraordinary liquidity measures to the national government to help fund the pandemic response measures. These include the provisional advances to the national government, purchases of government securities in the secondary market, and remittances of advanced dividends. Third were regulatory and operational relief measures to maintain stability of the financial system and ensure public access to financial services. We counted loans to micro, small, and medium enterprises as compliance to the reserve requirement, increased the single borrower's limit, and raised the ceiling for real estate loans. We also excluded some loans from what's called past due and non-performing classification and allowed a grace period for loan settlement and restructuring of rediscounted loans. In our latest policy meeting on February 17, 2022, the Monetary Board kept the key policy interest rate steady at a historic low of 2%. The Monetary Board deems it prudent to maintain the BSP's accommodative policy stance given a manageable inflation environment and emerging uncertainty surrounding domestic and global growth prospects. Through its liquidity easing measures, the BSP has injected into the financial system about 2.2 trillion pesos, or approximately $42.9 billion in liquidity, equivalent to around 11.1% of the country's nominal GDP. Following the BSP's cumulative 200 basis point reductions in policy rate in response to the crisis, domestic market rates dropped. Despite the pandemic, international observers continue to have confidence in the Philippine economy, as shown in our credit ratings. On February 18, 2022, Fitch Ratings affirmed the Philippines' credit rating of BBB, a notch above minimum investment grade, citing economic gains that demonstrate sustained recovery from the COVID-19 pandemic. The country has maintained the same rating from Fitch and other debt watchers throughout the pandemic. And this is despite a wave of rating downgrades in many other countries. Moving on to the economic outlook. Considering the recent economic developments and continued improvement in vaccination efforts, we are optimistic that there is sufficient support for the country's recovery in the near term. The management of risk through calibrated quarantine restrictions, the expected revitalization of key industries due to government policy support and structural reforms, and the improvement of the global economy should help the economy to accelerate in 2022. After a higher than government target growth of 5.6% in 2021, the government projects that the Philippine economy will grow by 7 to 9% this year and by 6 to 7% next year. The restoration of global growth with the easing of restrictions in many jurisdictions, along with increasing vaccination rates and improving job markets, could contribute to domestic recovery through improvements in exports and remittances. Moreover, the CREATE Act could shore up investments and business activity and in turn, boost the country's actual and potential output. The Economic Development Cluster is proposing a 10-point policy to accelerate and sustain economic recovery. The latest baseline inflation forecasts are within the target range at 3.7% for 2022 and 3.3% for 2023 under the 2018-based CPI series. However, the current account deficit is projected to reach 2.3% of GDP in 2022, driven by further widening of the trade in goods deficit as imports growth is seen to continue outpacing exports growth. Overseas Filipino remittances growth in 2022 is expected to stabilize at 4%. The projected improvement in global growth prospects and further opening of economies, along with the continued mass use of vaccines to prevent the spread of COVID-19, will support the growth of remittances. Foreign direct investment inflows are projected to reach $8.5 billion in 2022, amid expectations of improvements in the domestic and global investment climate this year. However, economic recovery is expected to be uneven between advanced and emerging market economies. The path to recovery will depend on the rates of mass vaccination and the effectiveness of policy support. Furthermore, the uneven exit from the pandemic may pose varied challenges to policymakers, as tightening monetary conditions in advanced economies may affect the recovery path of emerging economies that rely on international financing. There is also the increase in inflation, both in advanced and emerging market economies, due to firmer demand, input shortages caused by supply chain bottlenecks resulting from mobility restrictions and weather disruptions, and rapidly rising commodity prices. Also, we have witnessed since the start of 2022 the potential emergence and spread of new variants is an ongoing threat. Elevated global commodity prices, heightened geopolitical tensions, as for example, the Russia-Ukraine conflict, and the uneven pace of vaccinations across jurisdictions could dampen the outlook for global economic recovery. Moving forward, the central bank's actions and policy thrust will continue to be anchored on its core mandates of promoting price and financial stability. On monetary policy, the BSP will remain vigilant over the current inflation dynamics to ensure that the monetary policy stance continues to support economic recovery to the extent that inflation outlook would allow. On the financial sector, the central bank will intensify its monitoring and surveillance and ensure that supervised financial institutions remain responsive to emerging risk and demonstrate soundness, stability, resilience, and inclusivity, such as through pursuit of digitalization. Finally, on the external sector, the BSP will remain supportive of policies that will help strengthen the economy's resilience to external shocks, including that of maintaining a market-determined exchange rate, keeping a comfortable level of reserves, and maintaining the country's external debt manageable. Allow me to end my presentation with these key points. The Philippines' macroeconomic fundamentals remain sound. The latest GDP growth suggests that the Philippine economy is on a path of a strong recovery. The latest baseline inflation forecasts are within the target range. The risks to the inflation outlook continue to lean slightly toward the upside for 2022, but remain broadly balanced for 2023. Banks remain sound and well capitalized. Our external position is robust, with more than adequate external liquidity buffer. Risk and uncertainties remain, but sustained implementation of targeted fiscal initiatives, as well as acceleration of the government's vaccination program, should help boost market confidence and economic recovery in the coming months. The BSP will maintain its accommodative policy stance given a manageable inflation environment and emerging uncertainty surrounding domestic and global growth prospects. Looking ahead, the BSP remains steadfast in striking a balance between providing adequate stimulus to the economy and preventing buildup of inflationary pressures and risk to price and financial stability. I'll stop here. Thank you for your attention.
Thank you, Governor Jokno. I hope you don't mind. We'd like to ask you a few questions. And at this point, I'd like to also bring in my co-moderator, Ben Kritz. And I noticed there's a hand raised among the participants. For those who are wishing to ask questions, I encourage you to please use the Q&A function in Zoom, and we shall endeavor to ask the questions that are posted there. Ben, you have first to exercise that. Go ahead.
Yeah, good morning. Morning, Governor. Thank you for your presentation. I have a lot of questions, but I'm going to try to prioritize these to the hot topics. With the ongoing war in the Ukraine and its impact on fuel prices, which has been going on for a couple of weeks now, there has been a swell of calls in this country for modification of the fuel tax, various subsidies, perhaps some relief from that. What is your stance on all of that, and how do you think the conflict is going to affect your outlook in particular? Over the near term, given that we don't really know what is going to happen, since this is kind of a novel situation.
Thanks, Ben, for that question. Indeed, we don't know what will happen, right? So, of course, the biggest threat will be the price on oil, because, as you know, Russia is the third biggest supplier of oil and gas. But we have done some computation on the impact of oil prices on our inflation and growth, and we have concluded that the threshold for oil, as far as we're concerned, is $95 per barrel on a sustained basis. Okay? Mm-hmm. And we're talking of Dubai, not Brent, Dubai oil. So as long as the crude oil prices average less than $95 per barrel, that will not change our inflation estimate. All right, so that's where we are. Any price above $95 per barrel on a sustained basis will of course will have an impact on our inflation target. Now, on the how can we intervene? I think the government is doing just right. I think some proposals, like we go back to the OPSF, that to me is ridiculous. I mean, why come up with such institutions, which was a failure by the way, it's an administrative nightmare to implement when we don't know exactly whether this will be a passing tragedy or a sustainable crisis, right? So let's wait and see what happens. But in the meantime, we have to address the concern of the mass transit system, and that's where the 2.5 billion for the Pantawid Pasada program under the OTR and the 500 million under the Department of Agriculture for fuel discounts to farmers and fisherfolk will be useful. I think targeted assistance is better than across the board coming up with new institution, block to old regulation, and all that stuff, right? Let's not rock the boat too much, because we still don't know what's going to happen. That's my take on this, Brett.
Okay, good. That's good to hear. Just my personal opinion. Now, I want to clarify something that you did mention early on in your presentation, but just to ask you, you talked about the gains in employment, and you did say, I believe, like I said, I want to clarify this. You did say, I believe, this is over the pre-pandemic level. What proportion of the recent gain in employment is actually new jobs, as opposed to people who may have been out of work due to the pandemic and are simply returning to the jobs they had before?
Well, actually, I don't have the disaggregation, but we just compared the number of jobs based on the latest survey and pre-pandemic numbers, and there's an increase of about 3.8 million. So there are new jobs, but I suspect these are not the same jobs, okay? Because some sectors have really not recovered yet. Those sectors which require a lot of contacts, like maybe bars and some tourism-related industries. Transport has not recovered yet, but I think with the opening up the economy, the jeepney drivers and the bus drivers can now accommodate 100% ridership, and so that will change the picture significantly. So while there has been on the aggregate level, there's been an increase compared to the pre-pandemic situation. I'm sure there's a disaggregation, but I don't have it right now. But I have looked at some aggregate numbers, and it is in the hospitality business and in the transport where there has been no significant recovery in workers, but there's been significant new jobs. And also another important indicator is the labor participation rate. It is much higher now than before. In other words, there are more people who are looking for jobs and are actually participating in the labor market than before.
Mm-hmm. Okay. All right. One more before I let Clink have a turn at you. You did mention the manufacturer's PMI, which I believe was the earlier figure. It was just slightly over 50. Correct me if I'm wrong, but we just had, I believe just today, we just had an updated figure. It is around 52.6, 52.8. I believe, so quite an increase. Do you have any idea what is driving that? Manufacturing, yes, but what aspect of manufacturing is really driving the engine here? Because it seems like things are picking up rapidly.
Yeah, thanks, Ben, for that question. In my presentation, I mentioned of a PMI of 50, which I thought is kind of it's not in line with the trend, and I think that's because that was after Christmas, okay?
Right.
But I think really things have picked up in the areas of manufacturing, as you mentioned, construction has picked up also, and the retail industry, I think, and also transport. With the opening up, I think it will increase further the transport industry.
Okay. All right, Clink, have you got some questions?
Yeah, thanks, Ben. I'd like to ask a question here posted on our Q&A function. This is from Paul, and he's asking about cryptocurrencies and how might it affect the Philippine economy this year, especially that most of the invested money in banks are withdrawn in investment or invested in decentralized trading. So, this is also a question that has come up in a previous forum, Mr. Governor. We noted back then that the New York Times came up with a column, I believe it was Paul Krugman, who was saying that cryptocurrencies may be the new subprime of our era. I was wondering if you can comment on the question and if there is opportunity or should we worry about cryptocurrencies?
Thanks, Dante, for that. Clink, for that question. We have actually, as part of our digitalization journey, we have a very efficient payment and settlement system, and we're focused on that. Okay, the PesoNet and InstaPay, right? So we would like to focus on that. And then on the cryptocurrency, we want. I keep repeating this. Cryptocurrency is not currency as far as we're concerned. Okay, it's crypto asset that you can't use it as a medium of exchange because it's so volatile, and I think the consensus among central bankers right now is that we should really not touch it we should not endorse it. Okay, and even for the consumers, it's kind of there's an appeal if you want to make easy money, but it's a very risky investment. Okay, so caveat emptor. Okay, you take the risk. We are not endorsing it at the moment, but we study it because it might, sometime in the future it might be useful, but we're not closely endorsing it at the moment.
Right. Are you worried at all, Mr. Governor, about this whole DeFi or decentralized finance movement that seems to be getting done? Because it raises a lot of red flags from a layman's standpoint. The fact that it goes around regulation or is meant to go around regulation, of course, that opens the possibilities of all sorts of mischief, not least of which may be money laundering and other criminal transactions.
You mentioned it. I happen to be the chairman of the Anti-Money Laundering Council, so that's a red flag for me, actually. So it proposes a big problem because decentralized means you don't know who owns that asset, right? Mm-hmm. It moves around quickly, and there is no pinpointing of who to run after. But right now we ask any payment operator or payment system that wants to work on this area to register with BSP, so that we know exactly when and how to run after them should there something happen. Okay.
Right. Sir, I was wondering if you could also wear your DBM at the end. This year will be the implementation. We'll see the implementation of the Mandanas-Garcia rule, and we were wondering if you see if you foresee an uptick in public spending, or will it be the same, or why will it be less? Because there, some are questioning that the absorption capacity of some LGUs. Do you think this will have any impact in our growth this year?
That's a good question, and I must admit that I'm partly instrumental for that decision to, as we give more resources to LGUs in response to the Mandanas ruling, that we should allow them, or we should assign to them, additional expenditure responsibilities, because we're downloading a lot of money to LGUs, right? And this is not new responsibility of the LGUs. The local government code is very specific. that they should be responsible for local infrastructure, basic health care, social welfare. Those are responsibilities that they should have been doing all these years. But in the meantime, because our Congress or our senators and congressmen would like to participate or in the action, the national government continues to provide for barangay roads, municipal roads, and provincial roads, etc., even small rural health units. That should be the responsibility of the local governments all along, ever since the local Decentralization Act was approved. So now it's about time that, since we have the national government has been asked by the Supreme Court to give LGUs more money, then it is but appropriate that we should assign to them the responsibilities that were assigned to them in the first place. Now, so there could be uneven implementation. That's where your absorptive capacity will come in. I'm sure that the bigger, well-developed LGUs can absorb this. They have the capacity to implement. So it is the lower level, maybe for the third to the fifth class municipalities, which would have some problems implementing this. So I propose that the national government should provide some technical assistance to help LGUs. Should they ask for help? Because some LGUs may not want to help. May not ask for help. So should they ask for help? I think there should be a unit under either the DILG or under the Department of Finance to help them spend the money wisely. Okay? That's very important. It is how you use the money, because if they use the money wisely, better than the national government, that's good for the economy.
Right. So, I mean, as an economist, what would you recommend would be the wise kind of investment? I mean, I don't think, the waiting sheds will be the sort of things that, what you'd like to recommend, but what kind of investments do you think would qualify as wise that in a way would earn the LGUs a higher return on that spending?
I think as simple as farm-to-market roads, linking the market, the farms to the market. I think that would be nice. Right now, these decisions are made by congressmen, and I want to respect local autonomy. I think the mayors know best where to put that farm-to-market road, rather than the congressman who's most of the time in Manila. So, to me, that could be an improvement.
Right. Sir, I was wondering if you can talk a little bit about the election, because that's around the corner, and a lot of Filipinos are watching the candidates now being interviewed by various media. But what do you think should be the economic priorities of the next government? And regardless of whoever wins, what should the next government prioritize on the economic front?
Looking at the approval rating of the president. Right, at this time, I mean, this is unusual, right?
Yes, sir.
At this time, his popularity rating is very high. We suggest that maybe Filipinos like what he's been doing, and I agree, because this president has actually focused on build. That should continue, right? The build program should continue. You're linking lagging regions to leading regions, and you're connecting islands. So we will, plus we are fixing our urban transport system, which is, of course, in comparison with other Asian neighbors, it suffers a lot, right? So we should continue that. And there are a lot of projects that have already been approved by NEDA, okay? And I think the next government, it'd be wise for them to just continue these projects, because they have a very strict criteria. Any project that has a rate of return of less than 12% will not pass, okay? Their go no go decision. So these are worthwhile projects, and they don't have to reevaluate because it takes time. So there are many projects that are ready. There are some big projects that are ongoing. I think they should continue, like the subway. I don't think they should stop the subway, which will be completed in 2025. And then there is this they passed this Public Service Act. Well,
Yes.
foreign investors can come in and invest in infrastructure, telco, shipping, etc. I think they should combine that with the public-private PPP program, and so that will solve it. Because the problem with the PPP under the current system is that our domestic investors do not have enough capital to invest. Okay, whereas if you bring in foreign capital and technology, I think that would be good for us. So that's number one. And then I think because of the pandemic, we should focus also on human investment in human capital, which this government is doing, education and healthcare, etc. And then I think another important area, I'm going to discuss this for the first time, is we should formalize agriculture. If you look at the past administration of our history, we focus on agrarian reform, which means breaking up economic size farms into small uneconomic size farms. And as a result, agriculture has been a laggard in our economy. If you look at the performance of agriculture, it's really the laggard, right? So we have to invest in agriculture. How do we do that? Well, I would say that any any corporation that is listed with the stock exchange, therefore the ownership is white, should be allowed to purchase a piece of land, no matter how big, so that they can invest in agriculture.
Commercial farming.
A lot of idle lands, right, in this country. If we invest in informal agriculture, plantation agriculture, we'll be producing a lot of agricultural goods that will address our self-sufficiency, or rather agriculture security desire, and we can export a lot of this. And an efficient agriculture means that we will revitalize our manufacturing, so manufacturing industry. That will be a big boost. And the other thing is, I think in mining, I think we should really invest in mining. The contribution of mining to our economy is minimal, almost less than 3% or 1%. So, but we have a lot of minerals in this country. So if we invest in agriculture, that would be great. And rather in mining.
Right. One last question on trade. Would you care to comment on the delay of the ratification of the RCEP, or the Regional Cooperation Economic Partnership? Is it something to worry about, or because the DTI was saying that we might see a 1 or 2% uptick in GDP if we ratify it earlier, but we haven't done so. But are you worried?
I think the approval of RCEP is necessary for our economic growth, because then we'll be trading mostly with our ASEAN neighbors, and as part of that group, we can trade with the global market. I think I'm optimistic that it will be approved before the end of this Congress. Okay, there's a 2-week
window
after the elections window, and I think they should approve it. I think it's just politics getting in the way, or maybe they run out of time, but it is a necessary part of our development process.
Thank you, Governor. Any final words or message you'd like to share with our audience this morning?
Well, I think we should give credit to this administration for pushing through with many reforms despite the COVID-19. So despite our destruction from the 2-year destruction from the COVID pandemic, I think they were able to pass a lot of to be game-changing legislation. The last 3 bills that were approved, right? The amendment to the investment priority foreign investment, the Public Service Act, and the retail trade. I think those are game-changing, and that will be the kind of environment that the new government will inherit. And the other thing is, they should not get worried about our debt. Okay, our debt to GDP ratio, which is in the neighborhood of 60%, is manageable. Okay, all we have to do, first of all, we need to borrow money because otherwise we will still be stuck in the pandemic crisis. Right now, it has improved. The situation in the Philippines has improved. I think we're the only country in this part of the world where the incidence is declining significantly. Others are rising. Okay, so it has improved because we have invested in the vaccines, and that's because of the lending, the borrowing. So the debt to GDP ratio is manageable. Why? Because it's only 60%, and our economy is growing much faster than the growth of the debt. Remember, that's numerator, denominator, debt, GDP. Yeah. As long as the denominator is growing much faster than the numerator, we're in good shape. It's manageable. Our foreign debt is not huge. It's only 1/4 of our total debt, which is manageable. So there's no foreign exchange risk, and our peso is fairly stable. We have huge reserves, we have hefty reserves, and the inflows are coming through overseas Filipino remittances, BPO receipts, the FDIs, and exports. So there's nothing to worry about with respect to the debt.
Thank you very much, Governor. We have to leave it there, and I really appreciate you've been very generous with your time with the Manila Times, and we hope to have you again at the next event, sir. Thank you.
Thank you, and keep safe, everyone. Ben and
thank you, Governor.
Thank you. Ben, would you like to introduce our next speaker?
I would be very happy to. Our next speaker. If my file can, there we go. Okay, our next speaker, I'm very pleased that he was able to share time with us this morning. And Ndiame Diop is the World Bank Country Director for Brunei, Malaysia, Philippines, and Thailand. And he took that position on July 1st of 2020. He oversees the World Bank program in the 4 countries and leads the policy dialogue with government counterparts, civil society, academia, and other partners. The bank program in Malaysia, Philippines, and Thailand is a mixture of cutting-edge analytics and advisory services and lending operations focused on financially and technically supporting the country's development agenda. The World Bank team produces both inbound knowledge to support the 4 countries' key reforms and outbound knowledge to share these countries' innovative development achievements with other developing countries. Dr. Diop brings to this position 20 years of World Bank experience working across East Asia, the Middle East and North Africa, South Asia, and Sub-Saharan Africa. Prior to his current role, he was for 4 years practice manager for macroeconomics, trade, and investment for East Asia, providing technical and strategic guidance to the economic team working in Southeast Asia and the Pacific region. Preceding that, he was the lead economist for Indonesia, leading economic policy dialogue and the bank's advisory and development policy lending support to Indonesia. Earlier in his career, he worked as the lead economist for Jordan and Lebanon and World Bank resident representative for Tunisia. He is a native of Senegal, and he joined the World Bank in 2000 as a young professional following the completion of his PhD in economics the same year. Please welcome Dr. Ndiame Diop. Good morning, sir.
Good morning, Ben. Thank you very much for your introduction. And thank you very much to Manila Time, to Chair and CEO Dante, President and CEO Blanca, and you, Ben, for inviting me, and very warm greetings to Governor Jokno, Director Kelly Bird from ADB, the distinguished panelists, guests, and participants. The war in Ukraine and its implications for the global economy is, of course, in everybody's mind today. But let me step back and look at what happened to the global economy over the past 2 years and highlight the backdrop against which the current geopolitical crisis and its ramifications are occurring. In 2020, we witnessed a once-in-a-lifetime collapse of the global economy owing to COVID-19 and lockdowns. Global growth declined by 3%. Millions of people lost their jobs and incomes. global poverty rose for the first time in 20 years. In 2021, we saw a strong rebound of the global economy, 5.5% growth, reflecting the depth of the collapse in 2020 or a base effect, but also strong economic activities driven by less mobility restrictions and pent-up consumer demand supported by fiscal and monetary stimulus across the world. And early last month, the World Bank published its latest global economic prospect. This report clearly projects a deceleration of global growth from 5.5% to 4.1% in 2022 and 3.2% in 2023. And this is driven by the fact that pent-up demand will dissipate and fiscal and monetary support will be unwound in many parts of the world. Now, among the emerging market and developing economies, growth is expected to decelerate from 6.3% in 2021 to 4.6% in 2022 and 4.4% in 2023. This deceleration in emerging market and developing economies means that many of them will not reach their pre-pandemic trend by 2023, contrary to the advanced economy and some of the countries that have been rebounding quite significantly, such as the Philippines. Unfortunately, this gap between the recovery of advanced economy and the recovery of many developing countries will widen global inequality. But very importantly, the report highlighted that even the predicted deceleration could be made worse by several risks in the horizon. A possible future outbreak, rising global inflation, or possible financial stress linked to the rising interest rates in the advanced economy were highlighted. It is clear that if any of these risks materializes in emerging market and developing economies, the fiscal space would be more limited than in the previous years to address them. And this is the backdrop against which the war in Ukraine is happening. This war adds to the risk already foreseen in the horizon, but it also compounds some of them. And clearly, different countries around the world will be affected differently. What we are seeing is that the countries in Europe that have very strong trade and financial linkages with Russia and Ukraine now face not just a deceleration of growth risk, but a hard landing. For East Asia, the direct dependence on Russia and Ukraine through imports, exports, and capital flows is more limited. But the conflicts and the sanctions are likely to increase international prices of food and fuel because Russia and Ukraine are very large suppliers of these goods. So the spillover effects or ramification of the war can be very far-reaching. We're already witnessing an increase in the price of oil, gas, wheat due to the crisis. The rise in oil price will be felt across East Asian countries. And even though most East Asian countries consume more rice than wheat, they are nevertheless likely to see a possible increase in rice price. First, since wheat and rice are substitutes, the negative supply shock to wheat also tends to increase rice prices as some consumers shift their demand from wheat to rice. Second, the increase in fuel prices feeds through the increased fertilizer prices and hence the price of all agricultural product. We know that the negative welfare impact of a rise in food price is quite significant in the East Asia region. Rice, for instance, represents 8% of average consumers' baskets in the Philippines and 16.4% of the bottom 30% household. An increase in rice price would therefore increase poverty unless mitigated by targeted social assistance. Although the country is a large producer of rice, the country, Philippines, overall is a net consumer of rice. And so non-poor households will also feel the pinch. Even many farmers are net consumer of rice rather than net producer of rice, and therefore would be hit also by an increase in price. All of this is really predicated to the crisis in Ukraine, predicated on a continuation of the crisis and a consequent increase in global prices. So the question is, what can be done to support economic recovery from COVID and address this risk in the horizon? In the next few months, we see three things really as very important. And Governor Jokno mentioned actually all of them, and we did not exchange note at all. First, keeping the momentum of ongoing economic reopening, given the progress made in the Philippines in terms of vaccination. This is really an imperative for the recovery of jobs and income. Households and firms have experienced income losses over the past 2 years and need more income to face possible higher food prices or higher cost of production in the horizon. And the reopening of the economy is also important for government revenue collection. Stronger economic activities will generate more government revenues, which will provide the fiscal space to maintain the support to the economy and the support to struggling households. The good news is that the Philippines economy responds very strongly to reduced mobility restriction. We have seen how the economy has rebounded very strongly in 2021 when the mobility restrictions were relaxed. Second, keeping the momentum of infrastructure disbursements. Public infrastructure disbursements are programmed to rise in the budget from 5.1% of GDP in 2021 to 5.8% of GDP in 2022. So we think that this is very significant because this year it is reasonable to expect private investment growth to be less strong than usual because of the market uncertainty from the pandemic and the upcoming political transition. And furthermore, some corporations have seen their balance sheet deteriorate, and this may put their investment decision on hold for the moment. So in these conditions, the reopening of the economy combined with the ramping up of infrastructure capital spending and perhaps some more remittances will be really critical to support growth in 2022. Now, the third thing that we think is important is to provide targeted cash support or assistance to struggling groups in the event of an increase in price of food and fuel. Another bout of inflation on the back of what happened over the past 2 years could definitely translate into potential financial stress for some part of some household. And the sort of reopening or the income gains or wages from the reopening of the economy may not be enough really for some of the most vulnerable households to really cope with that. So using some of the higher revenue collection driven by the economic reopening to assist in a targeted way low-income families and struggling group is a sensible public policy. Now, moving on to the second part of the year, 2022, we see a few priorities really. One is to consolidate some gains, and second is to leverage new opportunities. It will be important, for example, to maintain the country's prudent macro-fiscal management that has served the Philippines so well over the past decade. Sound macro fiscal management, monetary policy, and fiscal policy is what allows a country to respond to shocks and maintain macro stability. And God knows that the Philippines is highly vulnerable to shocks. Prudent fiscal management, for example, prior to the pandemic, has really supported the debt ratio and brought it to a very low level, 40% of GDP. And that has provided the fiscal space to ramp up debt sustainably over the past 2 years to help maintain this economy afloat and to respond to the crisis. Now, going forward, it will be important to replenish the fiscal buffers through fiscal measures to collect more and spend better, or fiscal consolidation, as we like to call it. This fiscal consolidation is necessary to bring the debt ratio gradually over time in the next several years to its pre-pandemic level. And this is important because global interest rates in the next 2 years or 3 years are expected to gradually increase due to rising global inflation. And indeed, if interest rates rise higher than the GDP growth, the only way to reduce the debt ratio will be to lower primary fiscal deficits. So the Philippines has enjoyed low interest rates on its public debt thanks to low global interest rates environment, but also to the country's favorable sovereign credit rating. But between January 2021 and January 2022, inflation rose by 7.5% in the US. And this will force the US Fed to begin increasing interest rates, which will push interest rates globally. At least that will be the tendency. And of course, the timing of a fiscal consolidation should be data-driven. If the recovery is weaker than expected, implementing fiscal consolidation measures can further undermine the recovery. In this case, the government can announce it and provide forward guidance as to when or which data threshold will trigger the implementation of fiscal consolidation measures in earnest. The Philippines is very adept in and adroit in doing that. For example, on the monetary policy side, providing forward guidance to the public and announcing policies, what would trigger changes in policies. It will be like riding a bike. You commit to a path, but it may not be a straight line. So that part, the maintenance of fiscal or macro fiscal management will be really, really important. Now, the second key policy area is really to also maintain the good policies that have kept inflation manageable in the Philippines. It is inevitable to see prices increase from time to time. What is important is the ability to bring them down rapidly. The Philippine government and central bank have shown remarkable agility and policy acumen in responding to bouts of inflation over the past few years. The central bank inflation targeting framework has worked very well. And the Rice Tariffication Act has also been a structural measures that has helped to bring the price of food or rice down. Now, going forward, in addition to policies and programs to support domestic production, in particular agriculture, as actually was mentioned earlier, it will be important to maintain policies to facilitate trade and mitigate the impact of imported food and fuel inflation. The third policy area is really private investment and competition. It will be really important to broaden the scope of private investment and competition. Beyond 2022, The recovery will have to be private sector led, as the government will need to replenish its fiscal buffers to be able to manage future shocks in a sustainable way. Now, to boost private investment, it is critical to lower the barriers to entry into key sectors, to encourage competition and to facilitate the business operations of firms. A number of reforms have been enacted over the past few years, including the Ease of Doing Business Act, the Retail Trade Act, the Foreign Investment Act, the E-Commerce Act, and last but not least, the PSA Act, which is awaiting presidential signature. The implementation of these reforms would be really significant to improve the business environment and encourage investment and therefore growth and jobs in the Philippines going forward. Now, the last point second to last area that I wanted to mention is really the area of digital technology. We think that broadening the diffusion of digital technology to all the SMEs and households will be also critical as a way to for the economy to be resilient, but also to support the recovery. The pace of digitalization has accelerated in the Philippines, evidenced by the increased volume of digital transactions, the use of online platforms, the expansion of e-commerce. As evidenced from the Philippines business surveys that we've been conducting in collaboration with MEDA, adoption of digital technology has been linked to higher revenue, higher employment growth, and fewer chances of filing for business closure. Firms that have adopted digital platforms have experienced about 7% higher employment growth and about 10% lower probability for bankruptcy. But even so, the use of digital technology in the country has been uneven, with larger firms being more adept than smaller ones to use technology to improve their inventory management and their operations. So digital infrastructure also lags the peers in the region. The penetration of high-speed internet is limited and the prices are still high. So citizens and firms need affordable broadband internet to take advantage of digital opportunities. And improving the digital infrastructure, expanding broadband access to facilitate the use of more advanced technology will be a very critical support to resilience, growth, and would widen the opportunities for all. And then finally, let me mention the fifth policy area, which I believe is absolutely critical. And this is remedying some of the scars of COVID. COVID-19 has had a significant negative impact on education and health. And if not remedied, some lasting scars from this crisis could widen inequality of opportunities, because the negative impact of COVID has been felt disproportionately by the poor and the most vulnerable household. The majority of people have deferred non-COVID health treatment during the height of the COVID-19. This includes high-burden diseases such as cancer, diabetes, and hypertension, but also routine immunization for children. And in education, learning losses have been high for children from many low-income and poor families, threatening to widen learning inequality. So going forward, it will be really important to overcome the learning losses due to the COVID-19 while improving the quality of learning and teachers' training. And the cost of not doing that would be very high in terms of human capital loss for the Philippines, including foregone future wages and productivity, all of which will weaken the foundation of future inclusive growth in the country. So this is, in a nutshell, what I wanted to cover this morning. And let me stop here and thank you very much for your kind attention, and happy to take on some questions.
Thank you, Dr. Diop. I hope you can stick around for a little while as we hear from our next speaker, who will be introduced by Ben Kritz. Ben?
Okay. Our next speaker is Dr. Diop's counterpart over at the Asia Development Bank. Kelly Bird is the country director of the Philippines Country Office in the Southeast Asia Department at the Asian Development Bank, ADB. He was appointed to his position in January 2018. Prior to this assignment, he was director of the Public Management, Financial Sector, and Trade Division in the Southeast Asian Department at ADB. Prior to joining ADB in 2006, he worked as part of a USAID-funded project with the Indonesian government from 1999 to 2005, and in 2006 as a consultant on trade policy with the World Bank in Jakarta. He has a PhD in economics from the Australian National University, and he has published several papers in international journals, including Applied Economic Letters, Bulletin of Indonesian Studies, Journal of Development Studies, Oxford Development Studies, Southeast Asian Affairs, World Economy, and World Development. Would you please welcome Mr. Kelly Bird.
Thank you very much, Ben, for the introduction. Good morning, distinguished guests. I'd like to thank the Manila Times for inviting me to make remarks at this very important economic forum. Special greetings to Dante Klink Ang II, Chair and CEO of the Manila Times. My warm regards to Central Bank Governor Ben Diokno. I very much enjoyed the presentation and the discussion that followed, and also greetings to my colleagues at the World Bank, Diam Diop, and other panelists, and of course the guests. The COVID pandemic has occupied all of our attention in the last 2 years, and with several natural disasters in the mix here in the Philippines. Has created a lot of complex challenges for the government, development partners, the private sector, and of course for the millions of families and individuals that have been affected by it. But many of us are increasingly confident that while the pandemic is not yet over, it has been contained, and hopefully the worst is over. The government's vaccination program has hugely contributed to this improved outcome. I share Governor Diokno's optimism for the Philippines economy. In my message this morning, I will share with you ADB's outlook for the Philippines for this year and next year. Talk about some of the factors that position the Philippines to return to its high growth rates, but also the challenges around labour market adjustment arising from the COVID pandemic and the threat of climate change. I'll briefly touch on ADB's program with the Philippines for this year. We are working with the Philippines on some very innovative and transformative initiatives, and I would like to share them with you this morning. Turning to the Philippines economy, last year's very solid performance of 5.6% growth 2021 exceeded most of our expectations. As a result, ADB has upgraded its projections for the Philippines to grow at 6% this year. These are conservative estimates. The core drivers of this growth are the following. First of all, the government's successful vaccination program, where we've almost close to 68 million Filipinos being double vaccinated. This has helped the Philippines to relax those mobility and contact restrictions and reconnect with the rest of the world. These alone will boost the economic recovery for the first half of this year, and it should continue to help improve consumer and business confidence and restore jobs. And we are seeing this now in a number of the surveys that have been published, including most recently the PMI. The second factor, core factor that's driving growth this year will be public spending on infrastructure at over 5% of GDP. This will lift economic growth, especially as some of the big infrastructure projects start civil works this year. And finally, monetary policy remains appropriately accommodative to boost spending and private investments. We're looking at growth above 6% for next year. We believe the economy will be returning to its long-term growth trend. There are upside risks, and Governor Diokno talked about these, so I won't repeat them. There are also downside risks. Again, new and more dangerous variants of COVID virus might emerge, and this would lead to renewed mobility restrictions. Although I think this risk now is much lower than what it was, say, 6 months ago, due to widespread vaccinations. But it does highlight the importance of the vaccine booster program, providing added community protection for 2022. Supply chains disruptions that we saw in 2021 may also persist this year, constraining growth and lifting inflation. But critical for 2021 and 2022 growth is retaining public infrastructure spending at its current rates above 5% of GDP. This infrastructure spending is really the difference between Philippines achieving 5% growth as against 6% plus. So it is a very important growth driver in the Philippines economy, given the large deficit in infrastructure. With that, I'd like to turn to talk about some of the factors that position the Philippines well for returning to its long-term growth rate of between 6% and 6.5% annually. I'll just talk about two of these factors. And the first is the structural reform policies that have been implemented in the last 12 months that will absolutely lift private investment in years to come. To mention a few of these critical reforms, the Create law that lowers corporate tax rate down to 25%, but eventually to 20% by 2027, will improve efficiency in the tax system. The amendments to the Public Services Act removes restrictions on foreign ownership in some important sectors, which will bring in quality investments, new technologies, and will create thousands of new jobs. The Retail Trade Liberalisation Act, again, will bring in new technologies and create jobs, particularly in a sector that's been badly hurt by the pandemic. You combine these reforms with some earlier reforms like the competition law that was enacted back in 2015, the ATA or anti-red tape law that was enacted in 2019, and also the innovation law that was enacted back in 2019. Bring all these together, it has created a very strong foundations for the business and investment climate in the Philippines, and I think will be very transformative for decades to come. The second factor that's going to return Philippines to its long-term economic growth, which I mentioned before and others have talked about, is the government's Build infrastructure program, particularly investing in those transformative projects like mass public transportation, road and bridge networks around the Philippines. These will not only improve connectivity across the country, but they will improve long-term competitiveness of the Philippines and will help the Philippines, return back to its long-term growth rate between 6% and 6.5% on a sustained basis. I'd like to turn to two major challenges to long-term growth. There are a number of challenges, but I just want to focus on two today. That's labour market adjustment and climate change. The pandemic has created a massive reallocation of jobs across sectors, away from those sectors that are intensive, that are contact intensive, like tourism, retail, transport, towards sectors that are more information related. As the economy is recovering, many of these jobs will be returned, but this reallocation across sectors will persist as businesses adopt new strategies of doing work, such as digitalization, automation of production, and looking at adopting remote working arrangements. Also, the longer job seekers remain unemployed, the faster their skills depreciate and the less employable they become. These factors together have created this significant jobs mismatch, and many older workers will find it difficult to transition to new jobs because of the wrong skill sets and experience. We've also seen in the recovery that while employment has improved, a lot of this has been less quality jobs. So there's been a shift away from your formal modern wage job towards the informal sector. So we still see wage employment in private establishments below the pre-pandemic level, whereas over 3.5 million jobs have shifted to the informal sector. And the informal sector are your self-employment kind of jobs, which are less stable and less productive. Now, to facilitate, so the labour market is going to go through an adjustment, and therefore there needs to be a set of policy levers that help to smooth that labour adjustment. And I think this will require a strong focus on skills development and employment facilitation programs. We also need to think about new ways of delivering technical skills to job seekers and workers to ensure that they do have those skills that are relevant to the private sector, relevant to employers. And this is going to require reforms to the apprenticeship programs and introduction of innovative reforms to, or introduction of innovative workplace skills funding schemes. This month, ADB, in collaboration with the Department of Trade and Industry, the Department of Labour and Employment, and also the Department of Tourism, are going to launch what we've branded Skills Up Net Philippines, which is an employer-led training grant scheme. This month we will be reaching out to the private sector in the initial 5 priority sectors for consultation on the pilot project and how to access those training grants. And we really want to use this pilot project as a way of testing new forms of funding training in the workplace. These sectors are the first initial priority sectors are agro-business, construction, IT animation, tourism, and woman-owned enterprises. So we're focusing on these sectors because some of them are growth sectors, some of them have been hard hit by the pandemic, and clearly an upskilling is going to be required. I want to turn to the second challenge that's facing the Philippines, but facing all other countries, and that's climate change. Now, back in December last year, the Philippine government submitted to the UN Climate Change Convention, or generally known as COP26, its nationally determined commitments to reducing CO2 emissions to help mitigate the causes of climate change. Now, while the Philippines is not a major polluter, it's in terms of CO2 emissions, these emissions have increased in the last 2 decades and are forecasted to continue. So mitigating against these causes are still going to be important for the Philippines. The Philippines is affected, though, by climate change, and it is depleting water supplies, and it threatens food systems in the longer term. So this means both public and private sectors will have to invest in climate change mitigation and adaptation investments, and these will become substantial over the next 2 decades. The key for the Philippines is to plan now for both mitigation and adaptation investments, both in terms of mass public transportation, agriculture, and the health sector that are going to be critically important to adapt to climate change, but also in the energy sector to mitigate some of the causes. Innovative crop and disaster risk financing is also going to be important. It's a long-term strategy addressing some of to adapt to climate change. An innovative initiative that was launched by the Philippines at COP26 last December, and in collaboration with the Asian Development Bank, is the Energy Transition Mechanism, which aims to develop a financing mechanism for the early retirement of coal power plants and incentivize investments in renewable energies, while at the same time ensuring energy security in the Philippines. And this will be an important climate change mitigation strategy for the Philippines. Let me briefly turn to ADB's programs for the Philippines this year. ADB's programs has expanded over the last several years with a focus on infrastructure, investing in Filipinos, and promoting local economic development, and that will be retained over the short to medium term. In 2020, we provided financing of $4.2 billion, which was the largest in ADB that year, of which $1.8 billion was in support of the government's COVID response. Last year, we financed projects and programs amounting to $2.2 billion. These included our vaccine procurement projects, co-financed with AIIB, that procured and delivered over 85 million doses of vaccines, enabling the government to inoculate at least 42 million Filipinos. We also approved the Universal Healthcare Program that would help to secure healthcare for millions of Filipinos. We had a youth employment program, and we also had approved our Metro Manila's Bridges project. This year, our indicative program is around $3 billion, supporting infrastructure investments, particularly in mass public transport, climate change, capital markets development, and looking at a post-COVID business and employment recovery program. We're also preparing a TVET project that's aligned to our investing in Filipinos. So in closing, I'd like to thank the Manila Times for this event today. Also, I'd like to reiterate that the ADB remains committed to supporting the Philippines, our host country, in its journey towards high income status, low poverty, and low inequalities, and of course, being here for the Philippines in those times of need. Thank you very much.
Thank you, Dr. Bird. Please stick around. We will have a Q&A after our next speaker. And for those who are wanting to ask questions later, I encourage you to pose your questions using the Q&A function in Zoom. For now, Ben, could you please introduce Mr. Milo Sandig, our next speaker? Ben, you're on mute. Oh, there you go.
Got a couple of screens going here, so let me click that. Okay. Now, Milo Sandig is the president and CEO of Digital Innov. As president and chief executive officer of Digital Innov, he brings to the table a unique set of skills that encompass sales, business development, motivational speaking, business analysis, and leadership. He has a solid history in the management consulting industry. Was a business development specialist at Conrad Group, chief operating officer of SGC, president of Ames Realty and Development Corporation, and an independent distributor of Alliance in Motion Global Incorporated. He holds certificates in design innovation strategy from the GetCraft Masterclass, in data visualization from Udemy, in ad search and video from Google, and in digital marketing from the Internet and Mobile Marketing Association of the Philippines, as well as from the Yale School of Management. After getting his bachelor's degree from the University of Perpetual Help System, DALTA, he has earned postgraduate degrees in digital marketing, business management, marketing, and related support services from the University of Oxford in business analytics, data processing, and data processing technology from the University of Cambridge, and customer engagement, social media planning, and analytics from the Columbia Business School. Please welcome Mr. Milos Sande.
Hi, good morning. Thanks for having me. Thank you so much, Manila Times. Good morning as well to my presenters, co-presenters, and to all the netizens watching right now. Right now, I'll be talking more about the insights and how the Philippines behave towards the digitally towards the endemic. So there. So insights on digital behaviors towards the endemic. So the key points is the state of the Philippine digital economics, behavior of Filipinos towards the endemic. So here are my key points and things to watch out in the coming years. So allow me to share some data and interpret it from a digital marketing perspective. So here are our data according to the census. Right now, the Philippines has 111.8 million people. And here's the interesting part about it. The cellular mobile connections of the Philippines right now is 156 million. There's a lot more cell phones than people in this country. The internet users are 76.01 million. And the social media users are 92.05 million. Just a quick disclaimer, I talked to friends from Facebook that the 92.05 million people, social media users, actually include the troll armies, unfortunately, here in the Philippines. So the population essentials here is the median age of the population. I'd like to stress this point here from the economic standpoint is our median age of our population is 26.3, which makes it more ripe for growth. And also, these are the people who are very tech savvy. So the device ownership right now is for any kind of mobile phone here in the Philippines. For people aged 16 to 64 years old, it's 98.8%. So most often than not, as digital marketers, we make all our ads more on phones than more on screens that are on landscape mode. So here's the interesting thing about it. It's daily time spent with media here in the Philippines right now is 10 hours and 27 minutes. So can you just imagine how long usually people are exposed over the internet? And the time spent watching television nowadays is just 3 hours and 35 minutes. So the overview of the internet user in the Philippines is 76.01 million people. The interesting part about here in the Philippines again is there are places here that has no access to proper roads, or they have no real access to electricity or water, but they get 3G or 5G in their places. So from the internet users' perspectives, we got 3 data according to Kipios. For internet users, according to ITU, it's 52.4 million people in this country. For CIA World Factbook, it's 48.10 million people who's using the internet. And of course, for internet users as a whole, it's 91 million. Again, it's including the trolls. So daily time spent using the internet is 10 hours and 27 minutes. Time spent using the internet on their mobile phones is a lot higher. It's 5 hours and 47 minutes. Time spent using the internet on computers and laptops is 4 hours and 40 minutes. So mobile share of total daily internet time is 55.4%. We got some data about the main reasons for using the internet. It's mostly finding information, staying in touch with friends and family. That's the top two. As the elections come near, which is supposedly May, most people are searching more about their candidates. That's why it's more finding information versus the previous year. It's all about staying in touch with friends and family or researching how to do things. So these are the devices used to access the internet. It's 97.2% mostly on the mobile and laptop or desktop, because most probably people are working from home during this pandemic. That's why it gets a lot more higher. But the average Filipino right now has phones mostly on their pockets. So the most visited websites according to SEMrush is, of course, Google, Facebook, and YouTube. As a digital marketer, we focus on these three because Google has 499 million total visits, Facebook has 176 million total visits, and YouTube.com has 164 million. So I'd like to stress a point that people are searching most of the time. They don't really go to libraries anymore, so they get their information from Google and YouTube. So these are the main discovery apps. And if, as a digital marketer, or if there's business people here who want their digital campaigns to thrive, I suggest you look into Facebook as a good medium. So watching online video content, Facebook right now prioritizes videos over those posts that are mostly into words. So any kind of videos is 98.4%. They have this data that more people engage more with content with videos instead of posts. They tend to scroll it all up if you make them read. So I guess Filipinos really don't like reading nowadays. So let's talk more about social media, since it's shaping a lot about our country, and the same way as to how we are one of the biggest, if not the biggest, users of Facebook in this planet right now. So the number of social media users is 92.05 million. Year-on-year change in social media users is 3.4%. So the average daily time spent using social media is one of the highest in the world, which is 4 hours and 6 minutes. So the social media users over time is 92.1 million, compared to 5 years ago at January of 2017, which is just around 60 million. So here's again where it gets interesting. The demographic profile of Meta's ad audience is around 18 to 24 years old and 25 to 34 years old. But as the years go by, especially after the pandemic, more 45-year-old and above people started using the platform to get in touch with people or to get things done, to get their messages across. So these are the main reasons for using social media. A while ago, I stressed the point where I showed you guys why they use the internet. But here, this is why they use really social media. They try to keep in touch with friends and family. And the next one is finding content. And 3 is reading news stories. So people are reading news stories now more on the internet or social media than on the legitimate news outlets nowadays, like newspapers and TV. So the most used social media platform is not really rocket science anymore, which is, of course, Facebook and Facebook Messenger. The third is Instagram, and I'd like to stress a point that you guys look into TikTok, because it's starting to be more of a discovery app wherein you discover a lot of things instead of just being an entertainment app. So the most favorite social media platform here in the Philippines, of course, is Facebook by a whopping 40+%. Then Facebook Messenger, then TikTok. The use of social media for brand research, of course, is 84.4%. Social network, 60.3%. So most of the time, people use the platform just to research more on the brands that they look at. So web traffic referrals from social media, the highest would be Facebook, that's 85.44%, followed by Twitter at 3%. So let's look at how consumers spend online. So the use of financial services, use a banking instrument or insurance website or mobile app each month, that's 27.9% of the total internet user population. Use of mobile payment service, example is Apple Pay, or for us it's PayMaya or Gcash, that's 21.4%. And the thing I've been hearing earlier was about cryptocurrencies, people who've been owning Bitcoin or Ethereum, or because of the rise of NFTs and NFT games, we now have 19.4% of cryptocurrency ownership. Price of the cheapest smartphone handset in the Philippines right now in US dollars is $103.36, which is now the market for the CD and E. Whereas for 5 years ago, it was mostly marketing for BNC for markets here. So here in the app ranking with active users, it's Facebook, Facebook Messenger, then Lazada, Shopee, and Gcash. Those are the top 5. So that's where we look at with regards to active users base. So with regards to consumer spend, it's Facebook, of course, because big companies are spending tons and tons of advertising budget on Facebook. The next one would be Kumu and Bigo Live. These just came in this year. So let's watch out for these two for this year, because they're live streaming apps wherein people go there and just share their live stream and just talk and make people spend their money on how their performance are. So contrary on previous years wherein you watch your idols on TV, this time you watch average people become your idols and then you spend on them on these apps. So here are the financial inclusion factors. Account with a financial institution, it's 31.8%, and the credit card ownership is 1.9%. The thing is, we have a pretty low numbers when it comes to using online banking in the past year, which is 7%, but it's a lot getting better compared to the previous years, wherein it's just 2 to 3% of the population. So I guess it's more of a behavioral context of people wherein they would like to check whether it's more convenient. So as economic restrictions eases, I would see that people would still stick to digital instead of going back to how we used to. So I'm still banking on the new normal. So here are the number of people purchasing consumer goods via the internet. It's 43.31 million. Year-on-year change is 11.4%. That's 43.31 million people. And the total annual spend on online consumer goods purchases is $16.79 billion. So that's the economics that goes around the digital economy. So average annual revenue per consumer goods is $388. So I'd like to stress my point here about online travel and tourism, since this particular industry got a hit during this pandemic. So, but mostly our GDP relies a lot on this part. So the flight is $1.37 billion for internet. People booking their flights online, car rentals, trains. So these are the data for it. So holidays. So I'm expecting towards the endemic that these are gonna rebound really good. Filipinos love new things. So smart home market overview, wherein you could just control your lights, your aircon, your TV, everything starts to become smart now, even your refrigerator. So we are seeing a big jump on the smart home market as time goes by. So the digital media spend, annual spend on digital media downloads and subscriptions for the Philippines is $1.91 billion. It gets interesting with video games. We are a big video game nation. It's $1.48 billion. Then video on demand, 160.8 million. Then e-published articles is 238.4 million. And digital music as well. So the number of people making digital payments, of course, is $43.44 million. So the total annual value of digital payment transactions in USD is $16.11 billion. So their engagement with digital marketing is they research brands online before making a purchase, which is a good thing. Because back in the day, like 2014, 2015, we see a lot of scammers go online. Of course, we cannot discredit that there's no more scammers, but they have to make more effort now because people are starting to get better at researching brands, but it doesn't stop there. We still have to make an information campaign of some sort to stop people from getting scammed. So the sources of brand discovery, the problem here now stands with regards to information acquisition is social media ads. So this is where they get scammed mostly. Then the next is TV ads. At least TV ads, you get to pinpoint the right ads for the people. Then online retail sites, ads in mobile apps. Those are the main top 5 ads on websites that people mostly engage in with regards to brand discovery. So that is all. Thank you. So I hope I shared good insight for you guys with regards to digital behavior of the Philippines and how we could move forward looking at our digital economics here.
Thank you, Mr. Sanding. I'd like to bring back our earlier speakers, Dr. Diop and Dr. Bird, and of course my co-moderator, Ben. And if you don't mind, I'd like to ask Dr. Diop and Dr. Bird a question about the pandemic. You guys mentioned that, of course, it is a lingering threat and that you praised the Philippines for its vaccination program, but I think what we learned from Omicron, that is not just the Philippines. And I was wondering if you can comment on vaccine equity worldwide, because even the Omicron case that hit our country, came from an entirely different continent. And even while the Philippines is doing well in vaccination, we're still seeing, some corners in the world, many African countries, for example, with still very low vaccination rate. Ironically, there are countries in Europe that have protests against vaccine mandates. So I guess the point I was trying to make is that, unless everyone is safe, then no country, including the Philippines, is safe. And I was wondering if you could comment on that, and if there's a voice that the Philippines can add to maybe help address that vaccine inequity. Dr. Bird?
Thank you very much, Dante. I think in the particularly in Asia, there has been a strong support for vaccinations. So you've seen quite very good numbers across the Asian region. I think in the Philippines case, Philippines, Indonesia, very large countries, it's always going to be a challenge logistically to vaccinate a population. So I think when you look at that, with now almost 70 million Filipinos that are going to be double vaccinated in the next few weeks, that's, I think, is a success story. It also, I think, the lessons that Philippines can provide to other countries is, the challenges around logistics, around monitoring, surveillance, and particularly with managing the database. I think there's some good lessons that are that can be learned. I think there were, in the Philippines case, the other important lesson was that they brought in the private sector and the local governments into the procurement system very quickly at the early stages. That allowed the private sector and LGUs to procure vaccines. They also collaborated with them in terms of vaccination centres and so on. So I think they're the kind of the two big lessons that were learned from the Philippine side. I think like many other developing countries, they found themselves at the back of the queue in the vaccine supply chain in the first half of last year. That delayed reopening the economy. I think they have now done a remarkable job in catching up. I think because in the case of the Philippines, a lot of the vaccinations occurred from June until, since June of last year, community protection was fresh. And I think when the Omicron entered the country, there was a sufficiently large number of the share of the population that were vaccinated. And I think that helped to create protection. We saw that it surged very quickly early January, but in February we've seen it fall also very quickly, which is similar to other countries that have relatively large rates of vaccination. I think maybe the Omicron is also less dangerous variant compared to earlier versions like Delta, Alpha, and so on. So I think they're the kind of the lessons that are learned. I think another one was that the Philippines coordinated very closely with ADB, also World Bank and AIB in terms of together coordinating procurement of vaccines as well. And I think that also helped facilitate the process. I'll leave it there. Thank you.
Okay. Dr. Diop, you want to chime in?
Yes, Dante, not much to add. I think the Philippines has done very well. It's a good story. And I think we can see the implications right now. There will be challenges because what we see is that once you reach a certain high level of vaccination, then the sort of marginal improvement becomes more difficult just because you're digging into the sort of part of the population that is less willingly enthusiastic in getting vaccinated. And in addition, in the Philippines, you also have logistical challenges of going into islands and so on. And we see the same challenge in Indonesia as well. Now, as to the global the sort of global inequity and its implication in terms of infection or future outbreaks, I must say that it's very puzzling when you look at the correlation between vaccination and prevalence of COVID-19. And if you look at, you mentioned the African continent where the level of vaccination is very low, but at the same time, the level of infection is very low, which is something I think scientists should help us understand. Yeah. And in some cases, we also have, even within this region, Malaysia has a very high vaccination rate, around 90% of the population. And yet, the current wave is still
hitting them hard.
Yet. You compare the numbers between the Philippines and Malaysia, it's quite puzzling why it is still very high in Malaysia and why we have also this number of people in hospitals. So there are lots of question marks, honestly, which I think needs to be looked at. But overall, I am sort of personally more optimistic since the Omicron, because I feel like the global natural immunity has increased very significantly with Omicron. At some point in early January, almost everybody you knew in every country had a sort of flu or COVID. Right? I think most people would call it flu. Or flu-like COVID, but it was in most cases COVID. And I think that really is helping global natural immunity. But time will tell, of course. We'll see what will happen in the future.
Thank you, Dr. Diop. I want to turn our attention to recovery and inflation in particular. Of course, the central bank governor and yourselves mentioned the impact of Ukraine on pump prices. But an earlier development, I think last year, Ben wrote about it in one of his editorials, was Indonesia's decision to stop exporting coal. And of course, many of our local power plants are coal-fired. I was wondering if you comment on a couple of things. How big of a threat do you think inflation will be, given not just Ukraine, but the other events that happened before it, and maybe I suppose segue to climate change and what policies may be needed, and maybe as a related question for Mr. Sandig, there's a lot of energy consumed by cryptocurrency mining, and I was wondering if that's really a preferred activity, economic activity these days, given the rising cost of energy supply in the country. Dr. Diop, you want to go first this time?
Yes. For me, it's been a while. I'm a bit concerned about global inflation. Because I think it will be a natural correlation with the recovery. Because as you close the output gaps, and if the recovery is strong, there will be a natural pressure on inflation. And so far, I would say countries in East Asia, if you look at core inflation, which is the non-volatile part of inflation that reflects demand, aggregate demand in the economy, core inflation is relatively low in most countries in the region, including the Philippines. So what is driving inflation, or what might drive future inflation, headline inflation, would be essentially imported inflation, driven by the increase in fuel price and in food price. And those are really highly, I think, contingent on geopolitical risk, the war in Europe, and some global shocks that could push food price higher. So I'm reasonably optimistic when it comes to countries in East Asia that have been sort of calibrating their monetary policy in a way that helps manage inflation very well. But the risk of higher inflation is very real. And I think it has to be anticipated and prepared for. So on climate change, I think in the Philippines, definitely this is a very important agenda, in particular, the adaptation agenda. Philippines is very vulnerable to natural disaster shocks. And I think there is a very important agenda there to help adapt to climate change in key sectors such as agriculture, but also in urban areas with massive investment needed on drainage system, flood management, flood control systems, housing standards, and so on. And that is in addition to the sort of mitigation agenda, which I think is equally important in the Philippines. But as was mentioned earlier, the Philippines is not a big emitter. So I think Philippines would go green considering its own interests and how going green will support this country, the competitiveness of this country, jobs, and pollution. But if you eliminate all the emissions in the Philippines today, it wouldn't have a big impact on global emission. Having said that, watching the trend of emission from energy, in particular coal, is really important because over time, this can reach a level that could be very concerning, and the cost of taking action now is lower than taking action later. And that's why it is important as well for the Philippines to consider the mitigation agenda very carefully.
Okay. Dr. Berg?
Thanks, Dante. I think this year clearly there will be pressures on inflation, both globally and domestic here in the Philippines. We've seen quite extraordinary rates of inflation in several developed countries on a historical perspective. I think we saw a pickup in inflation in the Philippines last year, but it's gone back down to below its within its 2 to 4% range. But there's always going to be pressure on inflation. Clearly, higher oil prices are going to filter into domestic inflation through high fuel costs. As the economy continues to recover, globally, and if those disruptions to supply chains persist, you then get demand growing faster than supply, and so you get those extra pressures on inflation. In the Philippines case, where both the core and the headline inflation is moving, it's certainly at a much lower level than what we've seen in other countries. And I think there are a number of reasons for that. It's the agricultural liberalization that occurred a couple of years back has helped to remove some of those artificial pressures on domestic food prices. Also, in the economy, there's still excess capacity in the manufacturing sector, and in elsewhere of the economy, because it contracted by close to 10% in 2020. It recovered 5.6% last year, and we expect it to be back at pre-pandemic levels by the end of this year. So I think those pressures are a little bit less in the Philippines because of that excess capacity than, say, some other countries. But it remains a challenge. On climate change, this is something that the ADB is very concerned about, not just for the Philippines, but for all of our member countries. It is a combination of mitigation and adaptation. I think the benefit of the proposed energy transmission mechanism that the Philippines government has taken on board in terms of ownership is that it helps to remove it helps to address in a very market-friendly way early retirement of coal power plants, once the system is designed and up and running. That would allow the Philippines to reduce its largest cause of emissions in the Philippines, which is coal-powered plants, where coal now accounts for about, I think, 60% of power generation. What it also does is that a shift towards renewables can create a major renewables energy sector in the Philippines. So it could create, if I think this is where, the government, if they can develop a strategy for renewable energies, it could create a very important growth sector, and that could attract a lot of investment, and it can create some very high quality jobs here in the Philippines. So it's a potential growth sector, and I think focusing on that climate, addressing that mitigation aspect will be beneficial to the Philippines. It reduces CO2 emissions, but it creates a whole new industry, and a very high value added industry. Having said that, adaptation is going to be is a high priority. As I mentioned earlier, climate change is affecting water supplies. It is depleting water supplies. It does threaten food systems, and again, the focus will need to be on the water sector and agriculture in terms of adaptation. It also affects, the health sector and so on. So these are all sets of investments that need to be thought about now and planned, because it does take time to implement these kind of investments. It takes time to show the impact. I think if we are looking at the science now, clearly time is not on our side, and I do think this is an area that does require urgent thinking and planning.
Okay. Mr. Sending?
Yes. Thank you for that question about cryptocurrencies earlier. I've been one of the early adopters. For the past decade, I've seen the love and hate relationship of the speculative asset here in the Philippines, and not only in the Philippines, but also abroad. So, with your question about how cryptocurrency mining would affect the climate change and how its future is in the Philippines, I would say I would be one of the few digital people here in the country that would be pessimistic on how it could go here in the Philippines, because one is the weather. Mining rigs here in the Philippines, in general, they go to as high as 80 degrees easily. So can you just imagine 20 mining rigs in a room that goes as high as 80 to 90 rigs each? That would be really bad for the hardware. So with that, people would always be constantly changing their hardware for it. So aside from that, of course, it's better off in countries like mining is thriving in countries like Iceland. Tajikistan is one of the countries I see. Russia is one as well. So I think they've been using cryptocurrencies since they've been having so much sanctions all over the financial institutions worldwide. So as for the Philippines, I would say I'd be pessimist about it for now, unless we get good renewable sources here in the future. So that's my take on the piece. Thanks.
All right, Ben, I shouldn't hog all the questions. Do you have something to ask?
Yeah, I want to circle back around to the discussion on the climate change, because in my earlier conversation with Dr. Diop, he had talked about the importance of the energy transition, and of course ADB has just recently started the ETM program with the Philippines and Indonesia. And another thing that you said, Dr. Bird, concerning, the countries, including this one, should be planning now for, climate adaptation and climate mitigation. However, with the, as one example of, where maybe things aren't being planned too well right now, there was a report not long ago that said that the ETM is maybe going to be difficult to get off the ground because the Philippines in particular has locked in, development of new coal out to, several years from now. I think there's something like 15 plants in the pipeline, or around a dozen, and it may be hard to unwind those things. So when you say, and I'd like your views from both of you on this, when you say they should be planning now, apart from that ETM mechanism, what should they be planning to do now? What areas should they be looking at? With the energy transition being the big one, but climate adaptation and climate mitigation in general.
Maybe, Ben, if I can provide some thoughts. Philippines is not the only country that it's just starting to plan now. I think most countries are in the same situation, and you've seen over the last maybe 12 months countries making particular announcements on e-vehicles and so on, and moving towards mass public transport systems. So it's not just the Philippines. There's a lot of other countries that are starting to realize that we don't have time on our side. But it's critical now to start that planning process. Clearly, an area that needs to be focused on is how do you incentivize renewable energy investments. And in the Philippines, you've got geothermal energy, there's solar, there's wind. How do you get the right mix, the optimal mix of renewable energies as fossil fuels start to decline over time? You've got there are complications about you want to ensure energy security. You also want to connect all these renewable energies to the grid. The grid is segmented in the Philippines. You want to have a more unified national grid so that you can source other sources of energy. So that's one. And as I mentioned before, you can also start thinking about developing that renewable energy industry. And it wouldn't be all of it, but it'd be segments of that industry. The other one is, for example, electric vehicles. A lot of countries are now looking at that. They're investing in that. There are going to be different kind of production requirements and subcomponents of the electrical vehicle industry. There's another, batteries, for example. So there's a lot of different subsectors of the energy, electrical vehicle market that the Philippines could also think about tapping in. Now with those reforms in the Foreign Investment Law and Public Service Act, that provides a great opportunity for attracting high quality foreign investment in the energy sector or e-vehicle market. Would be areas that I think government could focus on with the private sector in planning. In terms of adaptation, clearly it's got to be a movement towards mass public transportation that shifts away from fossil fuels. The government is now doing some large investments in that with the railway systems and the MRTs, and I think that has to continue. The other areas is, water efficiency, proper irrigation, investing in irrigation that improves on efficiencies, that is managing water resources. I think they are some of the areas that need to be focused on. The government is focusing on it. It is starting to plan. But these are, as I mentioned before, these are long-term investments, and the gestation period is quite long as well. But I think, over the next 5 years, it is important to come out with some significant policy announcements on climate change that helps to implement the government's nationally determined commitments. I'll leave it there.
Maybe just to add a few thoughts on this. I think the starting point is that energy demand will increase and need to be met. And today, 42% of electricity comes from coal, and renewable energy accounts for 29%. Now, the current national goal is to increase renewable energy to 35%, if I'm not mistaken, by 2030, and more than 50% by 2040. And this is the plan. I think what is really important now is to go a bit more granular as to, how do you translate that plan into more specific areas that could galvanize private investment. I think the clarity of the plan and the trajectory will be really important to guide private investment and to align financing as well. Now, one thing that I will say, and we are doing climate change, call it climate change development report. One particular thing we're looking at is how do you make this transition work for people? How do you ensure that whatever transition you do, the price of electricity will be lower for households and for the firms? And I think that is really critical in looking into this, because that would really perhaps lead to some recommendations, more specific recommendation as to what the government needs to do. Now, on adaptation, I think this sort of separation between adaptation and mitigation is sometimes artificial. Because if you take the situation of the Philippines, how much adaptation you need to do is dependent on how much the others emit. So I think what it means is that the Philippines, the one dimension of the Philippines' engagement in climate change should be the engagement with the international community to add to the pressure for the larger emitters to reduce their emission, because that will have a positive impact on the Philippines in terms of less adaptation needs, less shocks to manage by the Philippines. So I see the climate change agenda as extremely important but multidimensional. Within each of the two large components, you do have really important areas where the government plans and objective could be announced and shared with the private sector to galvanize investment and facilitate their implementation. And it is also important to highlight the link between the two sets of agenda. So I think this is really the key area of importance, I think, for this country going forward. And I know ADB is working on this, the World Bank as well. And I think I'm hoping that soon we can really share some more insight from, for example, this report that we're doing on climate change and development at the World Bank. So yeah, let me stop here.
Dean, I just want to add also one thing that I forgot to mention is that we've got climate change, and so we've got mitigation and adaptation, but we also have the issues around biodiversity protection as well. So this is about conservation of lands and marine resources, and so both of them do go together. We often forget about it. We do focus on climate change because we see that as urgent, while countries have been moving towards conserving land, marine resources, in terms of protection of the ocean. Those rates are very, very low. And particularly in developing countries, you're finding that 1 to 5% of marine resources are protected through conservation laws and enforcements. So that's another area that also requires attention as we develop, talk about, and invest in climate change. So I think they both do go hand in hand.
Okay, well, I think we'll leave it at that for now. At the risk of giving too much away, you might both be interested in our editorial tomorrow morning. And this whole topic is something that we're going to be talking about again in the very near future. So I thank you both for those responses, and I hope you can stick around for the rest of the program. But I think we need to move along to our final speaker for the day right now. If I may introduce him. Okay, if I can get my mouse to scroll. Here we go. Okay. Mr. Aftab Ahmed is the Managing Director, Country Head, and the City Country Officer for City Philippines. Prior to this, he was the CEO for Hungary and Region Head for Hungary and the Balkan and Baltic regions in Central and Eastern Europe. He started his career with City as an executive trainee after getting his MBA. He has extensive U.S. and international experience. His career with the bank spans 11 countries: U.S., Pakistan, Greece, Saudi Arabia, New Zealand, Germany, Taiwan, Singapore, Egypt, Hungary, and now here in the Philippines. He has also been involved with City franchises in a number of other countries through cluster management leadership positions. His experience covers multiple disciplines, including business banking, corporate banking, correspondent banking, consumer finance, distribution, operations and technology, treasury, and country management. He has held a number of senior roles at Citi at the country level, including CEO for Egypt, consumer country business manager for Pakistan, corporate bank head in New Zealand, and O&T head for Citi in both Taiwan and Germany. He has also held senior cluster and regional roles, including director of retail branch expansion and operations for Citibank North America, consumer finance head for Asia Pacific, and consumer cluster head for Pakistan, Middle East, and Egypt. In his different business and leadership roles across multiple geographies, Aftab has been extensively involved and has successfully contributed towards country and regional initiatives to grow franchises, expand the branch footprint, increase the customer base, and deepen relationships, and protect as well as grow portfolios. Aftab believes that leadership is not just about leading people to achieve goals and deliver results. It is also about mentoring and contributing towards the growth and development of his team. Giving back to less fortunate communities is an advocacy that he personally shares with Citi, which is an exceptional global corporate citizen. Through the support of the Citi Foundation, the company provides grants to approximately 7 financial inclusion initiatives on an annual basis here in the Philippines. Would you please welcome Mr. Aftab Ahmed?
Yes, thank you very much. The only other person who would give me that elaborate introduction would be my mother. And Mr. Ang, thank you very much for having me here today. Esteemed members of the panel, ladies and gentlemen, good afternoon. I'd like to start off by thanking all of you for being here and for giving us the opportunity to share our perspectives. As we all know, the pandemic has posed challenges for the past 2 years. And while it's taken a toll on business and economic activity, the country has remained resilient. This is substantiated by the fact that the macroeconomic indicators have remained strong, the country's ratings have remained unchanged, and various business sectors are either performing well or are on their way to recovery. The Philippines continues to be rated 1 notch above investment grade by the rating agencies, owing to its strong macroeconomic fundamentals. The agencies' ratings are supported by the assessment that the Philippines has high growth potential, has moderate government debt levels, and has a stable and resilient banking system. This is commendable in light of the fact that between January 2020 and March 21, the 3 agencies collectively downgraded 48 countries, but left Philippines with the same rating. The overseas Filipino workers' remittances with inflows of 31 billion and BPOs with an additional 31 billion in revenue generation continue to support the balance of payments position of negative 0.2%. Both of these sectors have witnessed growth over the last year, 5% and 8% respectively. The BPO sector is expected to grow by an additional 5% in 22, further driving demand for real estate and office space. And when talking to people in the real estate business, I can point towards several projects that are going up to support the growth in the BPO sector. Additionally, the 5-year CDS, or credit default swap rate, for the Philippines has come down from a high of 162 basis points in March of 2020 to 72 basis points on February 3rd of this year. This is a very positive development, and it highlights that the country's credit risk is perceived to have improved and has moved onto a stronger footing. The Philippines is making steady progress towards pre-pandemic levels when the 5-year CDS was in the 40 basis points range. The Philippine Stock Exchange Index has also recovered from its lowest point in March 2020, from 4,623 to 7,212 as of February 24th, 22. This is considerably closer to pre-pandemic levels, with 2019 ending at 7,842. Although lagging its peers at the start of 22, the Philippine stock market is now outperforming many of its counterparts in Asia. Positive foreign investment sentiment is also evident in the total net direct investment flows, which has been on the rise since 2020. For the 11 months of 21, foreign direct investment added up to $9.2 billion, or 58% more than the prior year's $5.8 billion. Fixed income securities presently account for approximately 75% of the country's FDI, grew by almost 82% year on year to $6.8 billion. What is also positive is that many of the large multinationals operating here continue to reinvest their earnings. Total reinvested earnings for the period grew by 13%. The strong economic backdrop and favorable investor sentiment permeates into various business sectors. Industrial capacity utilization is inching closer to pre-pandemic levels, 67% as of December 21. Key growing sectors despite the pandemic include financial and insurance services, construction, professional business services, transport and storage, telecommunications, and utilities. Recovery is slowly expected for impacted sectors such as tourism, hospitality, and retail. We remain optimistic as regards a further enhancement in economic activity in 22, helped by a lower alert level, herd immunization, and booster shots. I'm confident that the GDP growth for the year will be close to 7%, if not better. Additional factors that provide a tailwind to growth is the lifting of travel bans and removal of mobility restrictions. Consumer spending is slowly recovering from the sharp decline in 2020 when it dropped by about 7.9%, growing to 4.2%. Food and beverage account for almost 40% of household spending, and we expect to see further growth in the fast-moving consumer goods, as well as in food and beverage manufacturing and e-commerce. As highlighted by the credit rating agencies, the banking sector remains stable and resilient to the crisis with strong liquidity. The loan-to-deposit ratio, the deposit-to-loan ratio is 143%, and capitalization, as gauged by the capital adequacy ratio of 17%, is strong. Loans grew by 4.3%, and non-performing loans remained at the 4% level. So the banking sector performed well, very well. In terms of our priorities, as we approach the pandemic endgame, we remain committed to be the trusted advisor of our various stakeholders and continue to provide support to the BSP's focus on ESG and digitization. On the ESG front, the BSP's strategic plans to develop sustainable finance in the Philippines and its three key pillars, which are creating a conducive environment, 2, mainstreaming sustainable finance, and 3, developing a sustainable pipeline, serves as a concise guidepost on how all players, both international and local, need to operate to achieve the country's imperative to transform into a more sustainable and environmentally mindful society. Citi's global efforts and its regional efforts, as well as locally, are very much aligned to supporting the central bank's framework as highlighted by the following. Citi, on a global level, has issued our sustainable progress strategy with 3 main tenets. 1, low carbon transition. Accelerating transition to a low carbon economy through our $500 billion environmental finance goal, which forms part of our $1 trillion sustainable finance goal to be met by 2030. Climate risk. Measure, manage, and reduce the climate risk and impact of our client portfolio. 3, sustainable operations. Reduce the environmental footprint of our facilities and strengthen our sustainability culture. What I'd like to share is that we remain to be a key player in sustainability, co-creating the Green Bond Principles of 2014, signing the We Are Still In declaration in support of the Paris Agreement in 2018, and co-developing the Poseidon Principles in 2019. For our own operations, we are targeting net zero emissions by 2030, which builds on Citi's environmental footprint goals. We have raised over $40 billion for clients in Asia Pacific from both the international and local capital markets in 21 to support their sustainable financing needs. This is an increase of over 500% versus 2020. As various players in the Philippine banking sector have taken the necessary steps in creating their environmental and social risk management systems, Citi served as framework advisor to the establishment of their sustainability financing framework. And this has been expanded to advisory with our corporate clients too. We've raised over $1 billion in green and sustainable bond financing for Philippine clients over the last 2 years. The next topical issue is digital transformation. It is a very topical subject and is indeed and something that's important to all. And on this front, I'd like to share a couple of interesting facts that have impacted customer buying behavior. 25% of consumers use mobile devices to purchase at least once a week. 160% expected increase in frequency of digital purchases as reported by Global Consumer. And almost 50% of employees will work remotely at least part of the time post-COVID. Now, there has been an exponential growth in e-commerce and online sales, but what is important to note is that there has also been a dramatic shift in healthcare, education, remote work, and even financial services, which companies will need to factor into their forward-looking plans. The BSP continues to champion transformation in digital payments, focusing on digital payment streams, digital finance infrastructure, and digital governance and standards. On an industry level, there has been an increased focus in enhancing the digital banking proposition for our customers, synergizing the payment pipes available with value-added solutions for both institutional and retail customers. Disruptors in the industry continue to increase the drive to digital, with 6 companies being granted a digital banking license by the BSP. As a testament to Citi's commitment to digitization, we were named the world's best digital bank in 2021 by Global Finance magazine. On the thought leadership front, our Treasury and Trade Solutions and public sector groups have engaged governments around the world on the topic of digitizing governance, covering various segments from cybersecurity to payments and financial inclusion. In the Philippines, with the advent of NRPS and the emergence of PesoNet and InstaPay, Citi has endeavored to differentiate itself in its offerings to its clients. We complement the electronic account-to-account transfer with digital channels and connectivity, providing corporate clients with the ability to integrate with Citi for transmitting secure payment transactions through APIs. Clients sending payment instructions can do so with a high level of confidence that the payment being made are valid and secure. Citi Payment Outlier Detection helps flag transactions that are outside the norm and require additional security or scrutiny prior to payment to prevent fraud. Now, Citi has also rolled out the Citi Direct Banking Evolution Document Center, providing clients the option to upload scanned documents to support FX linked to cross-border payments, allowing efficient compliance and timely disbursements. For import payments, where BSP registration is required, we've designed an automated experience for our clients, which involves import registration documents being submitted electronically for Citi to warehouse and advised on payment due date to ensure that supply payments are made on time. And I think all of this highlights the fact that we listen to our customers, we work with them to address their needs, and do so with a high level of innovation and a high focus on meeting and exceeding expectations. Citi's platforms also promote visibility of payment status with an automated advice sent to payment beneficiaries. Payment processing is handled on a 96% straight-through processing basis. As the digital landscape continues to evolve and transform many facets of banking, Citi remains highly committed to playing a leadership role in the emerging digital ecosystem. Our digital focus and initiatives are closely aligned with that of Governor Jokno and the central bank's digital priorities. We are strongly committed to leveraging emerging technologies, differentiating as well as enhancing our platforms and value propositions, and remaining highly engaged on the financial inclusion front. The alignment with the BSP strategy and priorities is also evident by the fact that we're the number one bank in terms of peso net outward value handled, moving 4 billion pesos daily. We're the number one foreign bank in tax collections, 11% of total BIL annual collections. For the last 28 years, we continue to be the sole settlement bank for the Philippines domestic dollar transfer system. And finally, our thought leadership through our active involvement in the Philippines Payments Management, Inc., or PPMI, is with the intent of working with the government and the banking sector to achieve and enhance the digital framework in the country. In closing, I would like to thank Mr. Ang. I'd like to thank Manila Times for the opportunity to share our views pertaining to the pandemic endgame. We look forward to the continued partnership with various stakeholders to support the Philippines economy. Thank you very, very much.
Okay, thank you, Mr. Ahmed. We're glad that we have you sticking around. And that will about do it for our forum today. But I'd like to give, first of all, before I forget about it, I would like to offer a special thanks to Hilton Hotel Manila for our wonderful refreshments today. Thank you. I look forward to getting into that just as soon as I have a chance. And I would like to offer our speakers a moment or two to offer us any final words they may have. Mr. Ahmed, since you went last, would you like to offer any final thoughts?
Just one. In addition to the fact that we're celebrating our 120th anniversary in the Philippines this year. It's been 120 years. So this clearly highlights that we are very committed to the Philippines. This is an exceptionally important market for us, and we are highly confident that the economy will do well this year. So I would like to leave it on a high note that we're committed to this market, and the economy is well positioned to do exceptionally well.
Well, it's been a
strong GDP growth number.
It's been a long time since we've had some high notes, so I think that's very good. Thank you, sir. Mr. Bird, any final thoughts?
Thanks, Ben. Actually, no final thoughts from me. Just to thank Manila Times for inviting me to this forum. I've enjoyed it very much. I think the discussion's been fantastic, and also to congratulate Citibank on their 120th anniversary in the Philippines. I think that's wonderful. Thank you.
Thank you, Mr. Bird. Thank you.
Okay, thank you, Dr. Diop. Your thoughts as we say goodbye.
Not much, Ben. Just to thank you and Manila Time and the organizers for this very nice forum. I think the discussion was very rich and insightful. Thank you for that. And we very much look forward at the World Bank to partner with everybody on the reform platforms that we have discussed during this forum. Thank you again, and thank you for the very, very delicious lunch that I was just enjoying a minute ago. Thank you.
Okay, thank you. Mr. Sandig, any last words?
Yeah, thank you so much for having me here, and congratulations to Manila Times for an amazing forum. You can be rest assured that we'll be very committed in this country to create the very first unicorns that we will be having in the future. So we'll be very optimistic about that. So there.
Okay, thank you. Well, that will about do it for this forum. And once again, thank you to all you gentlemen who joined us today, and to Governor Jokno, who, busy as usual, has gone off to take care of some other things. Again, thank you to Hilton Hotel for our lunch, and to all our sponsors and partners today. Please join us again soon for another exciting forum. We have some things planned, and they'll be surely worth watching. And just a final thought for me, I personally believe that we are at a point where we can start thinking positive, just as Mr. Ahmed said. It's time for a positive note, and I think that's warranted. So hopefully things will be a better year this year. We'll certainly all do our best. Thank you, everybody. Thank you to everybody that joined us in the audience today, and please join us again next time. Goodbye.
Thank you.
Was so beautiful, nothing could tear us apart. A picture of forever and promises made from the heart. But memories fade as time slips away. Where does that leave me and you?
I'll never forget.
I'll take you there one day.
Promise?
Promise.
So tell me how to love you with no more regrets. Now cherish these moments, the memories you'll never forget. The memories you'll never.
I may sometimes forget you here, but never here.
The memories you'll never forget.
knows its pulse like BDO Unibank. With leading scale and reach, the expertise and local knowledge to connect you to Philippine business. BDO Unibank. We find ways.
From the beginning, mankind survived by following rules. Rules that are measured by faith and made with wisdom. It is written in Genesis chapter 6, verses 15 to 16. This is how you are to build it. The ark is to be 300 cubits long, 50 cubits wide, and 30 cubits high. Make a roof for it, leaving below the roof an opening 1 cubit high all around. Put a door on the side of the ark and make lower, middle, and upper decks. Capitalizing on the historical learnings of Noah on how the ark was built with precise instructions, Noah Business Applications has been meticulously designed to deliver substantial results that complied with the financial and operational requirements of various companies across different industries. The success of Noah Business Applications is rooted in its strong, proven, and sustainable implementation methodologies from appreciation sessions to knowledge sharing. Noah conducted 4 levels of tests before he led all the creatures out of the ark after the great flood. All these tests were written in Genesis chapter 8 verses 6 to 12. These tests are paralleled with Noah Business Applications 4 levels of test, namely developers testing, system integration testing, quality control testing, and user acceptance testing. For 20 years, Noah Business Applications advances the roles of enterprise resources planning from forecasting, planning and budgeting, financials and procurement management, financial consolidation, loan management, real estate management, project management, healthcare and wellness management, human resources management, banking, warehouse management, production, distribution, customer relation management, mobility or IoT, analytics reporting and dashboard, and data management. Noah Business Applications, advancing the role of ERP.
First Park Homes was formed from the partnership between Century Properties Group and Mitsubishi Corporation, having that goal to raise the standards of community housing in the Philippines without costing too much. Unlike other housing communities, First Park Homes has actually what they call the 4 C's. It's the brand pillars which they follow. It stands for complete, conceptive, connected, and convenient. Oh, complete because their homes are fully finished, which means the walls are painted, you got your complete flooring. This place is secure and you got provisions to expand. Basically, all you need are your furniture and you're ready to move in. How easy is that? Conceptive because First offers amenities which go beyond the basic. Get this, for every subdivision, there is a specific theme for the amenities which can be enjoyed by both young and young at heart. They have amenities that promote the arts, encourage good health, build social development, and strengthen the community. Like for example, in Bulacan, they have these life-sized board games. In Lipa, they have traditional Pinoy games, and they even have an outdoor cinema. I think it's really amazing that they're introducing unique amenities for families to enjoy. First aims to keep everyone connected to life essentials. Imagine they even have a shuttle to bring you to nearby transport hubs. Now that is hassle-free. Lastly, convenient. Owning your first home is now easy through First's simplified buying process. Owning a First Park home is more than just an investment. It's your first home that lasts.
SM Investments is one of the largest Philippine conglomerates. We've been around for over 60 years. We have 3 core businesses, mainly retailing, banking, and properties. Over the past 60 plus years, sustainability is something which SM has had as a culture. It's something which we as a group has been practicing from the very beginning. We take into account the entire impact on the environment, including, let's say, providing sustainable energy, renewable solar powers, water treatment facilities, and waste recycling. We also provide, like for example, for our malls, we make the malls more like a community center which also then becomes like an area for relief effort if ever there's any sort of calamity that occurs. We also provide support in terms of education and training and healthcare, because at the end of the day, it's the sustainability of the community that continues to provide the growth for our businesses. Biodiversity is very important in everything that we do as a country and as individuals. For example, in our Hamilo Coast development, we work very closely with the WWF in terms of reforestation and also culturing more mangroves in the area.
There is this climate change that's looming over our Mother Earth. If we can contribute, no matter how little, and if I can get everybody to be aware of it, I think we will make an impact. It's never too late.
Sustainability is very important because for a business to be able to continue to grow and last for many, many years, it's very important that the business support the community in a sustainable way. Because in the end, it's also the community and the environment that sustains the high growth of our businesses.
The all-new Lulu Money app brings you more features and convenience than ever before, with more services under one roof than any other app of its kind. Send money to bank accounts instantly. Collect cash at popular agent locations. Send money to any mobile wallets. Pay your bills. Perform mobile top-ups. Load Lulu Money wallet. Check forex rates and much more. Lulu Money. Anytime, anywhere.
What's more important for you? Completing your to-do list or your shopping list?
Finally!
Is it making sure everything goes according to plan?
That's the plan.
Boom! Sold. Or is the plan not to have one? Bahala na. Whatever your choice is, we'll help you achieve it however you want to. Because at Maybank, we know exactly what you need. And that is to help bring you closer to what truly matters for you.